Right. All right. Happy Friday. Welcome to Real Assets Weekly. Today is Friday, the 16th of June. And with me for his inaugural episode here on Real Assets Weekly with me is Ryan Cobb, also known as Pescadero Energy on Twitter. Great follow. And we're very happy to have him on the show. So happy Friday, Ryan. Thanks for coming on.
You got it, buddy.
Yeah, man. So what we can talk about today that I think is will be interesting to our viewers is we talk a little bit about a company that Ryan knows pretty well. Ryan lives in shale country down there in South Texas, and so he can tell us a little bit about. We're going to talk a little bit about a company called Blackstone Minerals, excuse me, and Ryan's a landman, so he's going to tell us a little bit about what landmen do and he's uniquely qualified to touch on BSM because it's so interconnected with his daily day job. So yeah, great follow, great guy to have to be friends with, and we're really excited to dig in here with Ryan Cobb. So Ryan, maybe just to start, tell us a little bit about I mean, like I've alluded to before, I really think being a landman sounds like one of the cooler jobs on planet Earth. But tell us a little bit, like, what does a landman do in the day to day? It's kind of like a realtor for what's under the ground. Is that kind of fair?
Yeah, that's not a it's not a completely yeah, it's a rough
Erroneous.
description, but it's not inaccurate. It's
Yeah.
something that it's real estate for oil and gas. You're kind of like a combination of a title service, a leasing service, and a lot of times you're sort of the liaison between the landowner and the E&P. Um, and typically you do it as a independent contractor if you're let's say not employed by the company as what they would call an in-house landman. Typically you're going to be a contractor, and as a contractor you're kind of in a unique position because yes, you contracted the E&P, but you have a certain level of responsibility and ethics and how you deal with the landowner as well, because essentially you're your own business, and if you start mistreating people or you burn your name up, it gets really hard to kind of do business that way. And most of the exploration companies kind of understand that. So as that role, as an intermediary, your kind of job is to bridge the gap between the E&P's lawyers and what they can live with in a lease and what the landowner or their attorneys can live with, and you kind of come up with a game plan for how the property is going to be developed. And it's sort of the very front end of how these E&Ps go about acquiring, what we sort of attribute, if you want to call it net asset value or reserves, or what the fundamental building blocks of their valuation, is all acquired through this sort of ground game where they're out here in these known areas and they've done scalable geology and financial engineering, and they've kind of determined, okay, this is where we want to be. Then your job as a landman is to sort of get this big position for them. And the way the SEC treats it is you can kind of book these reserves strictly off paying for the lease. There's some rules governing like development. Yeah, you have to have like offsetting wells, like X amount of distance from the leasehold you own. So you can't just book every bit of oil and gas under the ground that you lease. But it really is sort of how these guys acquire value in the market, and it's really interesting because there's not really any barriers to entry. If you have a competent staff, there's a lot of technology transfer from the service companies, meaning, I hire a Halliburton to come frack well, or I hire, Ensign or one of the big rig companies, H&P, to come, um, do the actual service work. Um, there's not a lot that stands in the way of me just raising money and going out and buying leases and, trying to come up with a public offering based on the, the reserve potential, I went and leased up. So it's a, yeah, we talk about it being uniquely American, and it is that, because on one hand, there's nothing to stop, any independent wildcatter from going out and getting involved in this. But, it's up to the actual owners of the minerals to sort of determine who they lease to and who ends up, developing the land, which is a pretty interesting dynamic, really.
No, yeah, like you said, especially with some OPM, right? Like go get some public money, like list your go IPO some shares or get some money from Wall Street and then throw some leases up, and it seems like you could really you could see how you could you could get some numbers looking pretty good pretty quick. Um, Talk a little bit more. I think that's really interesting standpoint about the uniquely American aspect, and that's because, or tell me if this is right, it's because basically in other countries the government owns what's under the ground, and it's kind of a mostly a uniquely American thing that you can own the mineral rights underneath the property that you own. How does that? Is that
Yeah,
mostly right?
yeah, I think so. I think there is other countries with private ownership rights,
Yeah.
but
Do
one
they
thing
have
that's
resource deposits?
I they might, and that's actually a really interesting thing to touch on real quick. There is a lot of analogous shale plays throughout the world,
Yeah.
but the most unique thing about America, in my opinion, is that historically, outside of the big like NOCs, Exxon, the big nationals,
Yeah.
Wall Street has been kind of hesitant to underwrite oil and gas development because it carries it used to carry a lot of geologic risk with it, meaning you can't always identify where the commercial deposits are, and you kind of can put yourself in a position where you don't succeed, you drill dry holes, or a big discovery doesn't pan out economically the way you wanted it to. And historically that was just part and parcel of exploring for hydrocarbons 2 miles under the ground, and obviously there's been some big companies over time, but once we sort of figured out how to get in the source rocks or the the shale plays, um, that was pretty unique because these things exist in this weird heterogeneous fashion throughout like an area, and it sort of took away that geologic risk and made it a lot more like real estate. And of course, that was sort of coming at a time coming out of the housing bubble burst is when it really, we had the fracking and horizontal drilling technology 20, 30 years ago, but it wasn't until prices sort of skyrocketed in 2009 through 11, post the housing bust, where you could sort of try these new horizontal and fracturing techniques um, at a more commercial level because of commodity prices. And, that in and of itself helped us sort of spur the necessary sort of learning curve it took, because we could go frack and drill horizontally anywhere in the world. But what I guess Wall Street didn't really realize at the time, or investors didn't really realize at the time, is we just sort of circumvented this longstanding geologic risk with price and engineering risk. So even though we could go drill these wells and they were repeatable, these wells were costing $13-14 million to drill. And it's not a matter of whether you make oil or gas anymore. It's, do you make, $13 million worth of oil and gas plus
Right.
your hurdle rate of whatever it took to, to sort of invest. Like the full cycle costs were never really disclosed to investors early on. And, when we talk about OPM, there was a lot of OPM that was kind of incinerated in the past 15 years, really. And that was just, people sort of being swept up in the fascination of repeatable oil and gas companies that could go out and lease land and all of a sudden get this valuation for their reserves. And it was almost funny. It almost was like it was a tech market or something for a while. People were like,
Yeah.
this isn't like some old extraction industry anymore. This is infinite growth,
Yeah.
and
AI.
we've sort of found out now that, you know, it's still digging up dinosaur bones, and it's still constrained by commodity prices. And, even though the sort of denigration of that euphoria and also the money in the sector is kind of caused a lot of atrophy over the last 10 years. It's also it's sharpened a lot of these companies and sharpened the service sector to a point where these guys have gotten a lot better at this stuff. And it presents a good opportunity because now we have that sort of mentality of, oh, shale is a Ponzi scheme. It doesn't make money. And that's kind of when you get these big turns, is when sentiment's dead and when, it's being written off. All the while, these companies have survived probably the worst of it and have kind of emerged on the other side with a decent balance sheet and a decent path to profitability. And I think that's kind of where we find ourselves, and just talking about the uniquely American aspect, it's really this kind of this cutthroat competition and access to capital that's driven the industry to sort of get these prices down to where we can explore this stuff. Whereas like Argentina or some of these other countries that have large shale deposits,
Yeah.
they're just not there on the cost side of things. It may be two or three times more expensive to drill something in the, what they call the Vaca Muerte shale in Argentina, which, by all, measures has the same characteristics of something like the Eagleford and same potential commerciality. It's just that, the price pressures haven't made it profitable the way we have in, sort of, well, we'll call it a free market American economy.
Yeah. Yeah, brother. So how does do American E&Ps go down there ever? Like if you ever go down and look at the
Yeah, so
Argentina shale
Chevron's
stuff?
tried it, and again, Argentina's government owned, so you're kind of getting these long-term government
Yeah.
leases, and they have some price controls there on commodity prices. That kind of like hedging. Sometimes it's favorable, sometimes it's not.
Right.
They're trying to incentivize it, and there's been some good wells drilled down there. It's just that, without the competition and the sort of incessant drivers of capital conservation, they just can't make it work. And that that's kind of, to touch on the part about it being interesting, um, that American has sort of developed this big energy security complex or whatever it is, over the past 10 years. That's a lot to do with it there.
There's a no, that's great. That makes a lot of sense. There's a Dick Cheney. I'm reading this the Exxon book, or I'm listening to the Audible about Rex Tillerson. It's called Private Empire, and it goes into like Rex's when they picked Rex to be the CEO of Exxon, and kind of like, yeah, maybe in some ways like the glory days of Exxon and stuff. And there's a quote that I'd heard before, and it's by Dick Cheney, and he says, "The good Lord didn't see fit to put oil and gas only where there are democratically elected regimes friendly to the United States. Occasionally, we have to operate in places where, all considered, one would not normally choose to go, but we go where the business is." And I thought that it ties in nicely with what you're saying. Look
We
at this
bring
chart,
our
man.
army.
Oh, go ahead.
We
Sorry.
bring our army, private army and mercenaries with this if they don't want to cooperate.
Yeah, exactly. Yeah, this looks, I mean, to your point, I mean, I think to spell out the investment case, I really think that there's a lot smarter than me have turned me on to the long-term, higher for longer kind of energy thesis. And I think this chart, I mean, don't make too much of this chart, but this monthly bars on natural gas prices. These are spot prices. It's almost like tech bubble-esque, right? Where it's like all this capital came in before the run up, and then most of that capital gets eviscerated. the enthusiasm leaves, and then all that's left is the hardcore survivors and some motivated. And so yeah, from that standpoint, maybe that's what makes it an interesting spot to start looking. Maybe, I don't know.
I like that. Yeah, and like how interesting is that chart?
Yeah.
Uh, Part of this is a function of natural gas kind of being like a kind of what I'd refer to as like an island economy.
Okay.
We do have LNG and we've got multiple uses for natural gas, but we don't really have like a globally fungible trade in natural gas the way we do oil.
Yeah.
And a lot of our domestic shale and other even conventional reservoirs that we drill, it's a lot easier to find natural gas than it is oil.
Right.
By definition, these source rocks are deep and hot, and in order to successfully produce a well for a long enough period of time, really um, capitalize on the commercial aspect of it, you need that reservoir pressure, especially in tight rock like the Eagle Ford or the Permian, in order to have that well continuously flow and not pressure deplete. And so you typically find gas in the hotter, deeper rocks because it sort of retrogrades over time. There's some geologist buddies that would kill me for that terminology, but outside of using like the term vitrinine reflection or something like that, it's I guess the best way to look at it is time plus pressure and heat sort of cooks the hydrocarbons and sort of retrogrades it into natural gas. And so the easiest and most findable rock in America tends to be mostly gassy. And as such, we have a lot of opportunity to continue to produce natural gas here, and a lot of opportunity to sort of waste it because it gets drilled and leases get held before there's pipelines or takeaway capacity to really get a lot of it to market. So a lot of it gets flared or a lot of it doesn't get produced. So in a perfect world, if we had a ton of infrastructure and not a lot of LNG or other places for gas to go, we'd probably be flush with gas for a long time, and we would sort of see this reversion to this baseline price in the 2s to 3s more often than not. But what's interesting about this, it's almost like the VIX or something, is that we continue to find natural gas, but we don't continue to build out infrastructure to get it to market. And so we sort of have these weird lags where we'll have sufficient natural gas supply, our inventories are at sufficient levels. Weather plays a big part of it, like the winter comes around and like last winter was really mild even through Europe,
Right.
And we don't draw down on inventory. Well, then all the lagging infrastructure gets put in place and more production comes online. And so you get this sort of rolling baseline price, but then it goes the other way. You have a really cold winter or inventories are really low, or you have some geopolitical crisis like, the kind of Germany or most of Europe's gas situation going into last winter.
Right.
You can just get these big explosions, and I mean, even like, even the smaller moves we sort of witness in this thing around, beginning of 2017 and 2019. I mean, those are face rippers,
Yeah.
in the grand scheme of things. And you see how quick they just mean revert.
Yeah.
So there's a reason they call natural gas the Widowmaker contract.
37% bar. Look at that. It's a monthly. And then a 35% reversal.
Yeah, and I mean, so I think when we talk about investing in natural gas, we need to kind of separate the wheat from the chaff. And I guess what I mean by that is like, how do we view the long-term plays on natural gas? Like, companies like Cheniere and, Kinder Morgan that are going to make their bones in long-term either infrastructure build out, which is sort of a steady rental fee for what goes through the pipelines,
Right.
you know, or in Cheniere's case, actually liquefying it and shipping it to different spot markets all over the world. And, you know, those are kind of how I see the best ways to play the long-term gas industry here. Um, but we also kind of want to like position ourselves asymmetrically, right, to take advantage of these big pops. And you know, when you get kind of down to this baseline where we're sitting here, it gets really interesting in terms of how do we start building, you know, some of that asymmetry into the portfolio. There's a couple different ways to do it, you know, and you know, outside of holding long dated natural gas contracts, which you're never going to want to do because of the structure of it, you know, it's always in steep contango. And so, you know, you can't really hold, you know, option or contract derivatives of natural gas for very long periods of time just because of the roll decay. But that said, you know, some of the pure play E&Ps and some of the royalty companies and some of the stuff we're talking about now, you know, we really do kind of have a lot of opportunity in that. And, you know, that's kind of what we're trying to discover here.
I love it. I love it. No, I think that's, you mentioned roll decay, and I think that an interesting from a chart comparison standpoint, like here's your price of natural gas. So yeah, if we wanted to invest in this, we could just, you know, put our hard-earned savings into something like UNG, right? Right. But no, right, because of the keyword that you mentioned, roll decay. And so cool. No, I really think that's it's a great setup. I think that to your point, the price of natural gas here, you know, it's probably not going to negative $40 a barrel. So maybe, you know, maybe this is an interesting place to start looking for ideas. But I really like the, you know, kind of what you were saying, touching on there, which is there are there's different durations, right? These are sine curves inside of sine curves, and basically you can lose a lot of money investing in natural gas prices, in natural gas prices and natural gas companies. You know, everyone knows the energy complex is volatile. There are ways to play it. So kind of generally going back towards the BSM thing. So what's so interesting about Blackstone Minerals, excuse me, and why we can, you know, why that's an interesting company to talk about today, is that it's a royalty play, and it's one of these companies that, you know, last time I checked, they have very little or close to zero debt, and so the opportunity for them to look, what if natural gas prices stayed at $1 for 5 years, which seems unlikely. But the opportunity for them to survive that and get to the other side is a lot higher than like a regular operator, right? Is that
Sure.
that's
Yeah,
yeah.
yeah. That's
So I think that's a really let's touch a little bit on BSM. So before we even get to BSM, one last thing though I meant to touch on. So when you say so mineral rights, right? So again, back to the United States, and the United States, you know, a landman deals with mineral rights, and so clearly, you know, like you mentioned, gas is abundant, oil. What other types of minerals do you deal with? What other types of minerals do landmen deal with? But the kind of main course is oil and gas. Is that true?
yeah. I mean, it can really be anything. You know, uranium. There's a pretty good uranium deposit down here. They do some mining in South Texas for that.
No shit.
You know, all like the you know the derivative hydrocarbons we talked about, oil, gas,
Yeah.
gas fluids. Um, you know, if you get into like surface mining, then you're kind of dealing with and also water. You know, water is actually a surface right.
Okay.
So the owner of the surface kind of controls that. And that's another unique thing is that in Texas, at least, the mineral estate is dominant over the surface estate, meaning that they can be severed. Like I can own the minerals and you can own the surface. And as just a surface owner, you cannot impede me from making an oil and gas lease and the
Wow.
operator going out there and drilling it. And
But that's my living room.
yeah, and it sets up an interesting dynamic because usually the company will have like a surface use agreement with the landowner and they will compensate them usually pretty fairly. But it's hard to say, like, if you don't have a right or a claim to the income stream from the minerals, like, who's to say, maybe you don't want a rig or a wellhead on your property, like,
Right.
it's hard to quantify what that's worth. So if you buy land here in Texas, and you don't get any minerals with it, you kind of run that risk sometimes and
Hmm.
get kind of ugly.
So you've seen situations where you could have to put what do they call those things? A iron donkey. You got to put an iron donkey in my backyard and I don't get compensated for it.
Yeah.
Like,
Um,
do I, but like, if you put one of those things on my land, would I get paid? Would I be compensated generally?
Yeah, you would. So if, like, say I come to you and I offer you a surface use agreement and you don't have any minerals, and I say I'm going to pay X amount. We're going to have a pad site that's 10 acres. We're going to pay you 10 grand an acre. We're going to clean up everything when we're done. We're going to restore the land when it's over. These are all, like, these can be 40-page agreements sometimes. They get pretty, like, meticulous. But
Yeah.
say you refuse it, right? Say, no, I'm not signing that. Don't want it. Well, the oil company can actually just go out there regardless and set this up. And, from there, you really just they have to pay you, like, basically it's a reasonable compensation based on, like, comparable deals.
Okay.
And that was really, nebulous, because you're talking about, okay, what did the guy next door pay the surface owner? And inevitably it doesn't work out well for the landowner. So,
Yeah.
um,
Right.
yeah.
Uh,
And I've been in some funny situations, actually, just in the course of my career. And it's funny you're talking about a nodding donkey or iron donkey. And I actually had an encounter with a real life mini donkey. We were we were drilling a well on a guy's place, not far from here. And long story short, we got to that point, refused a surface use agreement, didn't want anything to do with it. We got out there to survey it. It was a small well, it wasn't going to take much land, but I understood where he's coming from. But unfortunately, it's like the mineral owner has the claim, and you can't impede them from realizing their economic benefit. And so I get there to do my job, I survey it, and next thing I know, I'm being chased out of there by a miniature donkey. This is the meanest animal I've ever encountered in my life. It was nipping my ankles the whole way. I got hung on the barbed wire fence, and kicking me in the ass trying to get over the fence. And I'm like standing in the ditch, like, what just happened? I got attacked by a donkey. And, here comes the landowner running out there with a shotgun. And I'm like, in my head, I'm like, well, I'm on the other side of the fence. And I try to explain to him, I'm like, sir, like, I'm just doing my job. We've already been through this. I got the right to be out here.
Yeah.
I was actually a company landman at the time, so I was working for the company. And
Yeah.
anyway, so we had to get the sheriff to have a temporary restraining order on him, and which is kind of sad. You never want to come on to somebody's land and then have to get a restraining order against him. But it's
Nah.
like,
Yeah.
you kind of felt like either him or the donkey was going to get you if you had to go back out there. So
Yeah.
next day I go back out there, and I mean, I'm looking for that donkey everywhere.
Yeah.
And
Head on a
I
swivel.
get to the little area we surveyed, and I said, you know what? And I put a game camera up, like I would use for hunting or something.
Yeah.
And I said, it might come in handy. And sure enough, this guy killed one of his cows, a big bull, and used his little bobcat to drag it into the pit where the kind of mud reserves go for the well. And he called and filed a claim against us. So we killed his cow. His cow was worth $50,000. Well, I go check my little game cam, and here he is, like, sweeping up his tractor prints with a palm frond, and it
No
captures
way.
his tire of dumping this cow in the pit.
Uh-huh.
And then,
Man.
and then the the judge actually recommended bringing fraud charges against the guy. And
Yeah.
at that point, I actually saw him outside the courtroom, and I shook his hand and said, "Look, I'll pay you more than the original deal we negotiated. We don't want to get you in trouble. We're not here, like, we're here to do a job, and we realize it's, not pleasant, but we don't want this to be, we don't want this to be so contentious." And me and the guy actually talk nowadays. We're kind of like, I wouldn't call us friends, but it was just strange situation. Doesn't happen very often like that at all. But it's a long-winded anecdote there. But I think it's
That's
kind of
that's the most Texas shit I've ever heard, man. Now I
yes,
understand why all these Californians are moving out there. That's a great story. And no, I really have a little tiny bit better understanding of like what a landman does now. That's really funny.
Yeah. We get bit by donkeys, so there's hazards.
Bit by donkeys, chased off by fraudulent landowners. So so cool. No, let's spend some time here on BSM. I think it's a really interesting company. We could spend maybe 20 or 30 minutes talking about it. And what's so interesting about it, well, let's start here. I mean, number one, the signal, right? So part of why we're gonna have regular conversations here with Ryan, and this will be our playground here, our universe, our sandbox. And this is the Swami Energy universe. Worked with Ryan to slap this together, and we'll break it down for you next week in the different categories. We've got some royalty plays here, which we're going to talk about, which is Viper and BSM. We've got the global majors. We've got E&Ps. We've got some commodity prices. So there's some stuff to do here. What as an example, right? As an example of stuff to do. I'm not a pairs guy. I don't work for a pod shop. I don't need to like pair my trades off one for one or anything. But I do like trading long and short, and I'm always looking for opportunities. And that's what I want to get Ryan's help with over the coming months. And you guys can tune in and check along and follow along. And the idea is so, for example, like Venom, VNOM, which is Viper, and BSM, both royalty plays. I don't know a whole lot about either of them, quite frankly, but signal wise, that's an interesting pair, right? One
Sure.
quantitatively has a great Swami score, and one has a very weak Swami score. And the other one that intuitively I want to put this on with all my money, but that's when it gets dangerous, is something like ICLN, right? Pretty weak Swami score. If you look at what's in there, it's a lot of like just solar companies and stuff. And I think that like that's an interesting, we've all seen this crazy run here, and who knows, maybe the Nasdaq's up 70% year to date next time we talk. But this is a pretty extended run. If you thought that might be done, those some of those guys might be might be near the top end of the trading range. And so that's how you can kind of start to use this this universe. If you want to get the daily email, go to swamiresearch.com and sign up. It's all free. And with that, so that's kind of to set the stage. But again, the strongest score on here is actually our MLP EPD. But then aside from that, the second strongest is actually it's a CHRD, but the third strongest is BSM. So let's talk about that one. And again, I really think the idea of a royalty co going into or not going into, excuse me, in the throngs maybe of a bear market in natural gas is really interesting. It's these guys can survive. Oh yeah, they're paying a 12% dividend. We'll ask Ryan a little bit more about that, and how comfortable we can be with that. But these guys can survive, and they're geared towards higher commodity prices. It seems like a pretty interesting setup. But what do you think about all this, Ryan? And why do you think what do you like about BSM, and why do you think it's a compelling investment opportunity potentially?
Yeah, real quick, man. So this is that was a great segue into this because, kind of looking at the strength of signal score there, I think a lot of that probably has to do with the fact that royalty companies in general are some of the better proxies for, the natural gas and oil contracts. That being, like you said, they derive, 100% of their value as a company from their mineral assets and royalty assets. And there's no cost of capital associated with those, other than really just their personnel and administrative stuff, they would do it as a company. And a company like Blackstone has this big legacy ownership of these minerals. They're not, they are actively acquiring and replenishing things in the portfolio, but most of this stuff is legacy stuff. So, this is all just kind of embedded option value out there. And, the way these companies typically operate is they distribute most of their royalty income back to the shareholders, or in this case, the unit holders, being that's an LP. And so if you think about that in terms of a business model, as opposed to something like an E&P where you've got the cost of drilling, inflation in different materials, the cost of leasing, et cetera, it really is a little bit more, pure way to put on exposure to commodity prices, oil and gas prices. And I think kind of we're seeing a little bit of strengthening in the signal from some of these guys here because, oil's sort of bouncing around this big sort of, I guess what I would say is it's kind of like a heavy volume node of historical significance, anywhere from the 60 to 70 area is like, to me, the trend still looks down, but we're kind of getting into a territory where, if we don't take out 60 with some volume here soon, we're going to probably consolidate in this range before the next move. And so when you get these kind of weekly pops, is this weekly chart or monthly chart?
Yeah, monthly.
Okay. So yeah, even like on the monthly, you get a pop like, the green candle we're seeing here. I think something like Blackstone's going to tend to track that a little bit closer than maybe like even a really oil weighted company would,
Yeah.
That in and of itself makes for an interesting investment in these companies because, if we could, we would like to own the commodity in a little bit more pure form. But, obviously we talked about the contractual issues and the way a lot of the ETFs are structured. So this is a good way to be exposed to commodity prices a little more directly. And especially when you consider the distribution, because that's obviously subject to commodity prices and also, a function of the share price as well. But if prices go up, that distribution is going to increase, which likely means the share price is going to go up to close the gap on that distribution, So it has a little more linear relationship to most commodities, I think, than other names might.
Yeah, and to oversimplify it, you could almost say something like BSM represents an embedded call option on oil and gas rights in the United States.
Yeah, yeah, I think it kind of does.
So yeah, no, let's walk through this deck here. The deck's over a year old, so wouldn't base your investment on any of the figures here, but you kind of get this. There's some this page I thought was interesting and kind of helps wrap our head around how a royalty company works and so yeah. This basically the royalty, maybe talk us through a little bit like the royalty business the embedded the benefits of potentially owning a royalty business versus an operator. Maybe walk us through this figure here on the bottom left corner, if you don't mind.
Yeah, so kind of what they're showing you here is just the what their business model is they basically get this cost free. They not only collect money for leasing the land, they get a cut of the royalty income off every well that's produced on their land. And as such, that percentage may not be as high as the E&P. Here they're using 20% to illustrate. So meaning I sign a lease with it's called EOG. EOG goes out there and drills a well. Well, I get 20% of that royalty cost free, aside from the production and ad valorem taxes, which are just state severance taxes and like a kind of like a property tax.
Yeah.
So I get to take my share cost free, whereas GE gets 80% of the revenue, but they got to pay the cost of leasing, the cost of development, the finding and lifting costs, the operating and transporting cost, and their share of taxes. And so, a lot of these wells we drill in resource plays are pretty expensive, anywhere from 8 to 13 million, and that can kind of fluctuate based on service cost and materials. And what they're kind of showing you to the right is how I really like to look at things, which is, I run what's called a decline curve analysis when I'm looking at like a potential reservoir, something like the Eagleford or the Permian, and all that really is, it tells me, the shape of the well. It's going to start out making X amount, and it's going to decline X amount over 20 years. And it helps you arrive at what's called a EUR, or an estimated ultimate recovery. And really all that is the company's way of estimating what each well is going to produce, right? And so as a knock on to that, that's how much capital is going to be returned to one, the royalty owner, and to one, the working interest owner. And the shape of the curve really tells you how fast the capital is going to be returned.
Right.
And so from there, you kind of have to use like a present value equation to sort of discount that back to today's terms, And so most operators will say, well, I can go drill this Eagleford well at a 40%, internal rate of return. And then that Eagleford well will hold a 640-acre lease. And then I can come back in there 10 years from now and drill 5 pad wells and zipper frack them all at once and have this gigantic cost savings, with the facilities and the lease and all that already amortizing, And so that's how they kind of look at it from a development standpoint. And that allows them to put this sort of PV10 figure on their reserves. And so you can do the same thing with the royalty company. So I wouldn't say it's easy to model a royalty company, but there's a little bit less of moving parts. So you can sort of model what these wells are going to do across the spectrum of these people's property, and you can kind of know what their distributable cash flow is going to be, for a year or two. But that only works in like a static sense, because obviously prices are going to change and all that. But when I'm modeling something like this, I really kind of like to think about it that way, like this company's value is derived from the underground minerals it owns, and what are those minerals going to produce. You can't control pace of development, but you can think about pace, and you can also kind of factor in what about the operators and the pace they drill at. And like you said, it's kind of option value. If you just assume a sort of baseline real, modest assumption of what's going to get drilled on Blackstone's property for the next 2 years, and you break it down, and you find that, let's say their present value on a PV10 equation for the next 5 years is tied to X amount of wells being drilled plus the legacy wells that are already there that are still producing. You can kind of arrive at like a backhand figure of what the company's worth and what it's going to distribute. And the cool thing about this company is all this undeveloped land that's, doesn't cost them anything. If anything starts getting developed at a higher pace than what you predicted, well, there's tremendous value embedded in that. And, the cool thing is, if we're right and commodity prices go up, then that option value tends to accelerate because the companies are incentivized to drill more wells in a higher price environment so that they can realize those prices, So you can really kind of have this multiplier effect on a company like this if you kind of marry it with with good timing on the macro oil and gas markets.
Yeah. So no, that's really good stuff. There's a lot there. One thing from a portfolio standpoint, I'll pop to this LNG chart one more time, and or to natural gas chart one more time. And I think that to your point, your comment on the Widowmaker trade that I think is associated with different things in financial markets, but definitely I've heard it associated with natural gas many times. convexity, I think, is a word you used earlier that's really good. And you know, when you think about building a portfolio, and especially today with VIX at 13 or wherever we're at, it's really tempting to think about, like, how do I get something in my portfolio, 13 and a half on VIX right now on a Friday afternoon here in mid-June. And you think, you know, I wish I could just put some UVXY in there. You know, I don't know. It's so complacent. You know, volatility is a mean reverting asset. You know, that's a temptation, or just some calls on something that benefits from volatility upside. But as we all know, you don't get yachts like that. You go long vol, you don't get a yacht. How do you get the yacht? You go short vol. You know, FinTwit knows this. And however, with these commodity companies, or excuse me, with specifically like a royalty company that doesn't have a lot of bankruptcy risk, they don't have any debt. They've had debt. They could, you know, my understanding is they could go back into debt. That they could take out debt to potentially support the dividend or to support a dividend. But they don't really have a lot of go to zero risk. Unlike UVXY, or any of these
Sure.
long vol ETFs, and they're going to pay you 12% while you wait. And you know, this isn't a, you know, we're not here to just talk one-sidedly. Like, there's obviously another side of the investment case. We're not here to pump BSM, but I guess what I'm saying is, just from the standpoint of something that's energy prices going up, is generally bad for everything else. It's not, energy assets in general are not very correlated with the rest of your portfolio. And just for those two reasons, something like BSM that has such a positive carry is pretty interesting.
Yeah, yeah. Uh, you know, tremendous convexity, for portfolios that are probably, increasingly, you know, not convex nowadays,
Right.
especially, higher concentration of everybody chasing the NASDAQ. And,
Yeah.
it is hard to build sort of asymmetric convexity into your portfolio and still limit the downside. And that's really kind of what I'm looking at here, that
Yeah.
natural gas chart is wonderful because you're sort of sitting at this baseline here. And it's like you said, you could almost make the argument that a company like Blackstone preserves value in down commodity markets, because by definition, a royalty company is a declining asset. Like, I look at something like Viper Energy Partners, and I've owned them, many times. Venom is a good company, and it has really high quality minerals underneath it, but it doesn't have these legacy free mineral positions that Blackstone does, meaning all of this stuff is bought and paid for pretty recently, And when you're speculating on minerals in somewhere like Permian, well, you're paying up for them. And you know, for somebody like Viper, they've got a unique situation where they kind of have this drop down from Diamondback, which is kind of their parent company and the operator. And so they've got a kind of really good, uh, like forward-looking view of what's going to get developed and the pace it's going to get developed at. But they're also constantly out there in the market buying new mineral deals to replenish, the ones that are being depleted. And so technically the equity in something like Venom is deteriorating every time the distribution, is paid out, because you're monetizing something that can't be remonetized. And so if
Right.
we were to value these companies correctly, we would actually be, you know, sort of discounting their stock price as the, as the rock sort of produces its reserves. And the tricky thing for a company like them is they have to go out there and buy new minerals at a price that is going to be accretive to shareholders, or is actually going to pay out. And it's really hard to know if they're doing that, because they may be buying new stuff just to replenish the portfolio and doing it at an
Right.
you know, agnostic cost, because they know that nobody's really going to ever unwind how much they paid for them or whether or not those are going to
Yeah.
deliver value to the company.
Right. Because
Something
what's
like
managed?
Blackstone's just
Yeah. No, that's a great point. No, because what's the management incentive, right? Like management, if your business is kind of a melting ice cube, right? Like you have these resources. We're not yield farming here, right? Where I can't just it's not free money forever. So we have a melting ice cube of a business, sort of, as commodities are being produced, and management's incentive is to keep bringing in fresh supply so that the business continues. But maybe as a shareholder, if it's not economic acquisitions, then you might as well just give me my money back. I'd prefer that, right? That's kind
yeah,
of the
yeah.
on
They can go away with whatever they want to because
right.
nobody's really. I haven't seen one analyst cover these companies and
Yeah.
explain to shareholders that they have to continuously replenish these minerals, and you don't know what price they're paying or if it's being done at a, you know, because it's great if I can go, I'll just call it the Delaware Basin, in West Texas. It's great if I can go over there and buy 1,000 net mineral acres for $10,000 a net mineral acre. That may pay off in spades. But if I got to pay 35,000 a net mineral acre, well, it's unlikely that's ever going to deliver value to the shareholder outside of increased distribution. And
Yeah.
that's kind of an easy way for them to mask long term. You know, it's almost like it's almost going back to roll decay. You're almost kind of in that position because the company is sort of declining in value every time it pays you out. You know what I mean? You're sort of stuck in that same no free lunch, situation. Whereas, something like Blackstone it just has so much undeveloped acreage still. And, you could almost say that if prices just continue to get hammered and we end up in some really deep recession, whatever worst case scenario you want to paint, if 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 a lot of operators don't drill their positions on Blackstone minerals, Blackstone um, still has that same asset base that's probably valued at a little bit more long-term realistic deal because it's not going to get developed unless it's at a certain price. And so you really don't, I don't know how the stock would perform like that.
Right.
The market isn't that linear, but from a fundamental standpoint, you don't really lose any value, which is really pretty intriguing.
Yeah, so maybe we just kind of wrap on that. Wait, let's touch on hedging, but before we get to that, the legacy standpoint. So just doing a little bit of background on it. So these guys, it started with like a timber company and they had all this acreage, and then they sold the timber company and then kept the royalty option on of drilling it. And so tell us a little bit more about that. And then how does it and then do individual landowners still sell their assets to BSM? Like if I had mineral rights, would BSM be interested in buying them off of me? Two questions.
Yeah, most likely. I'm sure they've got some kind of ground game out there where they're out there trying
Yeah.
to buy new mineral and royalty positions. Almost all of these companies do. It's become a big. It went from sort of a cottage business to a big business, and I'm sure Blackstone is competitive in the mineral
Yeah.
buying market. But a lot of this is kind of just legacy stuff that is owned by that was owned by I don't know their history real well. There's a guy named Blackstone Dilworth who was sort of famous here in Texas, and he aggregated a lot of this stuff, in the 1900s through the 1930s, 40s, and so that was done at some just like astronomically low cost at some point.
Yeah.
And so, as far as being a shareholder, and it's all just a sunk cost from a long time ago, which is pretty cool.
So basically
Uh,
oh yeah. Well, just to pinpoint this. So on the map here, if you can see that, the blue is would they have the right to it, something, and then the red would be a producing well. I guess that's kind of the gist, and what takes it from, and if that's true, I don't, you tell me. And then, but then what takes it from energy prices, essentially, or the harvest value, if you will. That's what takes it from the right to produce to actually being produced.
Correct. Yeah. Mhm.
Gotcha.
Yeah.
So
I'm
it's,
not exactly sure what it's
yeah,
denoting.
yeah, I could see based on anyway. Yeah, well, it's all right. It's not your deck. Fair enough. Um, no, it makes a ton of sense, and that's yeah, and I think like we said, it's just kind of there's some embedded call optionness in the business model is really fascinating.
Yeah.
Um, maybe we could touch a little bit on hedging. So the fact that these guys are paying a 12% dividend with gas prices kind of in the tank here, what that's a function, my understanding, is partially of hedging. How does hedging work for these mineral guys? How do they do that?
Yeah. So hedging's always been a little bit of an enigma
Yeah.
business because, I guess technically, the easiest way to think about it is they kind of have an estimation of their reserves on a, pro forma year. They're going to know roughly what they expect to have produced and roughly what the cash flow is going to be from that production. And, I guess to uh, sort of mitigate the uncertainty of those estimations, you probably wouldn't hedge your entire, expectation for revenue, but say you go like 60, 70% or something. There's a couple ways to do it, because you're basically exposed at the wellhead to oil and gas prices. You're going to have a lot of differentiating or differentials, I guess, at the wellhead for wherever that particular mineral acre is, so you're going to receive a lot of different prices. It's not really going to all be WTI, NYMEX, it's going to be whatever derivative is getting paid in that field, based on how marketable it is.
Right.
Um, so you have a kind of tough time really knowing how close you can be on that kind of thing. But probably what you would do is just go into NYMEX and have some sort of option strategy, whether it's like a collar or something. Say they're going to produce 100 BCF of gas on all your acreage next year. Well, then you could have some kind of uh, strategy where say you collared that and sold NYMEX gas, um, sold NYMEX gas calls and bought puts underneath where you were comfortable, and not comfortable at. And so I guess maybe last year when gas was creeping up around 8 or 9, I know hedging was really tough at that point, because typically prices only run up like that if the market needs the supply and the market's saying, we don't want you to hedge, we want you to produce. So
Right.
the structure of the contract is so super contango, I mean, super backwardation where it's like, um, maybe it's 8 on the spot price, but 6 months from now it's 3.5 or something, Um, so it makes engineering a financial uh, hedging position a little bit difficult. And a lot of these companies have different ways of doing it. Some of them have like 3-way costless collars, where they sell calls, sell puts, and then buy puts, and it kind of offsets itself. Um, I would have to like try to dig into BSM's exact hedging strategy to talk a little more about it, but
Yeah. No, it's all right.
kind of figure out.
Yeah. No, but it's fascinating. It's interesting that they even, I mean, it seems like as a royalty, it would be, as a royalty company, it'd be less important to have a hedged price. But who cares what it seems like to me? Because I don't really understand how these businesses even work. But it's yeah. But I guess, is that true? Is it less, if you were a royalty owner or you're a CEO of a royalty company, would you be less incentivized to hedge than if you're Shell, the CEO of Shell?
Yeah, I think I would be, because typically you don't have the same cost, you don't have the cost of capital that you do at Shell, So I would kind of float with the market because I know I would get big runs. But also, I think, for somebody like BSM, they are a LP, and, you tend to have a little bit more tend to have stronger hands that are investing in LPs. You know, most people don't like the tax structure for one. So if you
Right.
are in it, probably you're probably not paper handing it or trading it much, you know? And
Right. That's a good point.
I think distribution is key to kind of, you know, long-term ownership. And so I think it's probably a little more important for them to focus on consistent distribution than it is big equity performance um, and playing the commodity cycle, which, you know, in the long run, which is why this is also interesting, you know, because talking about something like Venom, yeah, they've got their own problems from like a business model standpoint, but
Yeah.
they're a lot more free floating and they're a lot more levered to, um, you know, they're more levered to short run cycles. And, you know, I guess that's something that's pretty kind of unique is kind of figuring out which one of these companies are, let's go back to the trading sardines versus the eating sardines, you know, and
Yep.
kind of, you know, that's why we have a universe of signals, a lot of, you know, deep bench and names. And that's why we pay attention to the trading range, you know, so that we can sort of play off these different concepts and stuff. I look at Blackstone as more of a eating search. You know, this is a little bit more of a take your time, you know, build a position, um, use other companies to hedge against it, you know. Um, I guess if you're going to short, you know, if you're going to pair trade or something, it's kind of hard to pair trade royalty companies because the distribution is so big.
Yeah. Right.
I kind of
Yeah.
hold that and eat that, but
Yeah.
uh, at the same time, you know, there's some nice like there's some other ways to pair this kind of stuff off. So, you know, I'd be looking at something like this as a long-term hold and using other tools to kind of mitigate my risk to the commodity sector, you know. So
Man, that's a great way to break it down. Yeah. No, that's fantastic. And I really think the eating sardine versus trading sardine is such a great point, and especially in energy, especially, you know, you really touched on almost like an easy way to like start your own energy company with you know, without adding a whole lot of value to anybody, with other people's money. And I think there probably, you know, there was probably because there's a lot of that in that part of the world in the years between 2016 and 2020. Um, and yeah, no, that makes a lot of sense. And to your point, yeah, there's a lot of trading sardines. There's not a ton of eating sardines, and that's what we're looking for. And I think that that makes a lot of sense. If you look at the as it as a analog to what could happen regarding the dividend cut, you know, like Ryan said, I'm not the expert on this company, but just doing a little bit of homework. My understanding is, you know, what they could, because they're a royalty play, they could cut the dividend and they could, you know, they could take out some debt to support the dividend. They could cut the dividend and they could raise it right back when commodity prices come back. And so my point is that, or I guess I'll close on this. I think you did a great job of walking through this. I really appreciate all that. Close on this question for you. So, or if I'm kind of thinking of it right. So if we see a dividend cut, that's not necessarily a sign of stress in the business model because again, they don't really have operations. They just don't want to, you know, they want to just support the dividend with cash flow. And that could be a potential buying opportunity as as it was as it has been in the past.
yeah, yeah, absolutely.
Yeah. What else? What else do you think the should we leave the people with here? Friday afternoon. I think we got a lot in on this component of it. One, there's a couple other topics to get to, but that's enough for I think for one day. I want to be mindful of your time. We'll get you back next couple of weeks here. And yeah, anything else you want to close on? Any other big thoughts you had?
Yeah, no, so man, it was great spending some time with you here and going through this. Working on a, you know, a kind of deep dive on the company and, you know, I'm going to give some thoughts on the macro backdrop too, you know, kind of spool it up that way, you know, where we look at where oil and gas prices might go and some different ways to invest in them and sort of get down to the details on something like Blackstone because I'm really interested in finishing up this kind of, you know, uh, sort of, I guess it would be a hybrid, uh, you know, kind of look at their reserves versus what we could maybe expect to see produced in the next few years. And also, there's a couple really good, like, uh, sort of unknown oil and gas plays that Blackstone has big ownership in that really haven't, you know, made any news in the market yet or anything like that. So, I'm kind of trying to develop a model with some reasonable certainty. Granted, it's never easy to, exactly figure it out, but I guess I think it's an undervalued company, and I think that there's probably anywhere from $15 to $40 a share in fairly in value that can be unlocked without everything having to go right. Meaning there's a even higher upside to that if we have some gigantic commodity run, oil goes back to $100, gas goes up to $5 or $6. But I think there's a potential for a substantial gain in this name, just strictly based off like a few things going right, and then obviously a lot of option value on top of it. So yeah, I think it's a good opportunity. It's something I'm continuing to explore with an open mind, and until I've done all the homework and math on it, I'm assuming that I could be wrong in some areas, but we'll discuss that too, and what the potential downfalls are as well. And yeah, we try to be helpful and not pound the table, unless it's unless we have to pound the table. I think I'll know more here soon.
Yeah, use these 200 YouTube subs as exit liquidity. The so no, that's a really good place to leave it. And I think, like, the back to the LNG chart, here, I'll close on this. Back to the LNG chart, or the natural gas chart. It's price drives narrative. Narrative doesn't drive price, right? Like, this was, I guess, peak fears of dark winter in Europe, or cold winter in Europe, whatever everyone on Fintuit was talking about last year. And then it just never manifested, and it kind of, so whatever. And there's good reasons for it. And it's not trolling anybody who had that call or anything. But I guess the point is that where, maybe that's this winter instead, or something. And again, not hoping for anything
never
bad.
went away. It just didn't happen.
It didn't happen. Yeah.
The way, like you said,
And there's a lot of confidence on FinTwit of bulls, and I really don't characterize myself by any animal spirit. Yeah, there's a lot of confidence that all these things just went away, and like you said, it just didn't, because it didn't manifest right then, doesn't necessarily mean it totally went away.
Yeah, that's right. And we'll see. This is another winter. Weather ultimately is might decide this one, but yeah, I don't really know what to say about the natural gas trade. Like, it could, I think from a risk reward perspective, like, you just look at where we're sitting. This is just sort of that baseline. Like, you definitely wouldn't want to be short here,
Right.
Like, it's definitely a asymmetric, but
well, it can't go below zero, but then again, maybe it can. But we'll save that story. We'll pull out Orion in a future episode. But thanks so much for tuning in. Real Assets Weekly, and enjoy the rest of your Friday. Ryan Cobb, thanks so much for coming on. Pescadero Landman on Twitter. Find him, hit him up for all your Landman needs, and have a great
awesome
Friday.
stuff, Carol. Appreciate it, brother. Have a good
You're the
one.
man. You're the man.
All right, buddy.